Hello and welcome to Moneylife News and Views. I'm Debashis Basu. There are two types of bear markets. The first one is a shallow one, a sharp fall initially, but then subsequent sell-offs are less and less intensive, and everything gets resolved in a matter of 4 to 5 months. For almost a decade, India and the rest of the world have got used to this kind of a bear market. The second kind is a deep bear market, which arrives in installments, making despairing new lows over months and sometimes years. These are interrupted by fierce rallies, each upswing offering just enough encouragement until aftershocks appear from nowhere to puncture the optimism again and again. Each time the market is in a dive, investors have to judge. Are we in a shallow or a deep bear market? The answer depends on how much of the trouble is from a single source. If it is, as was Trump's tariff war, let's say, it would normally be a shallow bear market because a single source problem usually gets fixed. If the sources of problems are complex and locked in a vicious cycle, as they were in the global financial crisis of 2008, which affected too many institutions and too many countries, it would be a prolonged bear market, the aftershocks coming from somewhere or the other continuously. The question is the current Gulf War the complex second type? The war centered on Iran has already delivered the opening sequence. Oil prices have jumped, equities have slumped. March was the second worst monthly decline post the global financial crisis, the worst being the COVID shock of March 2020. The question is, will these shocks be short-lived? Consider how such episodes tend to unfold. A negative shock, financial, geopolitical, or otherwise, forces a repricing of risk. Prices fall sharply, but markets are, of course, always forward-looking. They do not dwell on the present misery so much as they anticipate future relief. Any hint of stabilization, a central bank intervention, a diplomatic overture, a pause in escalation can trigger a rebound. Short sellers cover positions, bargain hunters return, prices rise, sometimes very briskly. At this stage, the media starts quoting experts saying the worst is over. However, a new wave of negative information arrives. If investors conclude it is new and surprisingly bad, the fragile confidence erodes quickly. Prices fall further to fresh lows. The cycle repeats. This jagged descent was on full display during the global financial crisis. The markets fell heavily in the first quarter of 2008, only to rally in April on the back of policy support. The rescue of Bear Stearns was taken as evidence that the worst had passed. It had not. Losses in the banking system continued to mount. At this point, crude oil prices suddenly climbed sharply, hitting a high of $147 in early July, pressuring equities all over again. Then came the failure of Lehman Brothers in September. A wholesale panic liquidation started in October and hit a firm bottom in March 2009. Each rally appeared at the time to mark a turning point. Each proved illusory. Even in July 2008, the Nifty rose a sharp 7% in the month as oil prices dropped from their peak. The relevance of this history lies less in the particulars than in the pattern. Prolonged bear markets are not smooth. Prices rise and fall as investors debate whether the worst is over. The longer uncertainty persists, the more pronounced these oscillations become. In the present conflict, the most immediate channel is oil. The Strait of Hormuz remains a choke point for the global energy flows. Even a partial disruption has pushed crude prices higher. At first, markets tend to treat such spikes as temporary. Energy shocks, after all, have often faded as quickly as they appear. But if elevated oil prices persist, they begin to alter the macroeconomic landscape. Energy feeds into transport, fertilizers, manufacturing, and ultimately food. What begins as a commodity shock becomes a broader inflation problem. Central banks, already wary of resurgent price pressures, find the room for maneuver constrained. An easier monetary policy risks fueling inflation, a tighter policy risks choking growth. This is the first way in which things can go wrong. The shock can prove sticky, inflation can settle at a higher than expected level, forcing a repricing of interest rates, bond yields can rise, and if so, equity valuations will fall in tandem. Markets that had been counting on relief must adjust to restraint. The second risk is that disruption spreads to the supply chains. Modern production systems are efficient but very closely knit and therefore brittle. Energy shortages, shipping delays, and input scarcities rarely remain confined to one sector. Firms respond defensively, they hoard inventories, delay investments, and conserve cash. What begins as a supply problem becomes a confidence problem. Growth slows, not abruptly, but persistently. The third channel is financial. For large energy importers, higher oil prices strain their external balances and weaken the currencies even further. You can see what's happening to the Indian rupee. Capital flows become more volatile, risk premia increase in such an environment. Even a modest shocks can have outsized effects as markets adjust to a world of tighter liquidity and higher uncertainty. Fortunately, this time too, the source of our troubles is just one: the unilateral war unleashed on Iran by Israel and the US. The US can end it as quickly. Once it does, supply can adjust while policymakers work to offset the shocks. Investors are currently working with this scenario. If US wants to forcibly open the Strait of Hormuz, probably type 2 bear market will reveal itself, arising from a complex and a very long drawn conflict. If you like this video, please do subscribe and do share. Thank you.